Jack, as a portfolio manager, how do you account for inflation in your corporate estimates and your outlook?
Sure, and there's a big difference here between real earnings and nominal earnings. And obviously with the inflationary backdrop, that real backdrop is making a big difference here. Nominal earnings, significantly higher. That's going to filter through to a lot of the bottom lines at corporate of America. But the issue is these aren't going to stay elevated for some time. Inflation is going to come down. And so near term, you're going to have to, I think, keep those elevated, but longer term, you're going to have to bring some of those estimates down more in line as inflation starts to come off. So big difference between now and, let's say, this time next year.
You also have to incorporate the Fed and their thinking into your estimates as well as your outlook. So how are you doing that?
It all comes down to that terminal rate. And we think the biggest risk in the market right now, why we're seeing all this volatility in the marketplace, the market has yet to get comfortable with that sort of terminal rate, that where the Fed fund rate settles in. And I think until we get that backdrop to settle in, this uncertainty, that volatility is going to continue to weigh on things in the marketplace. So for us, the market needs to get comfortable with that terminal rate. That I think will give us a little bit of a sounder footing to move forward here.
And the Fed's maneuverings are really pushing the dollar higher. How is this affecting your stock picking?
This is real interesting because a stronger dollar filters its way through into the financial conditions backdrop, and that's ultimately what the Fed is trying to achieve here, tighter financial conditionings to slow the economy. And if you think about it from a dollar perspective and an earnings perspective, roughly 50% of S&P earnings are coming from abroad, so obviously a stronger dollar is going to take a hit with regard to those earnings. And then the second one, global growth is going to slow, and that's going to filter its way through the earnings backdrop. So certainly, stronger dollar is going to have to see earnings estimates being pulled lower as a result.
Speaking of things getting slower, let's talk about the housing market. Clearly, it's becoming more and more depressed. How is this affecting your thinking?
The housing market's an interesting backdrop because we see a few different things coming out. And I think the biggest takeaway for us is we certainly expect to see some slowing in housing prices. Certainly wouldn't be surprised to see housing prices come off a little bit. But a big difference between seeing prices come down and a crash. And I think that's the big difference here. Certainly there's plenty of reasons to see the housing market hold up. One of the bigger ones being supply and demand. Plenty of demand, but still not enough supply here. That's going to put a floor under the market and prevent it from really crashing, so to speak.
Let's talk a little bit more about supply. Clearly, there's geopolitical worries about China. How are you factoring this into your thinking?
And this is obviously going to be a continued risk. That political uncertainty, that's one of the things the market does not like. And obviously, the geopolitical backdrop between China and Taiwan is going to continue to linger for some time. For us, that uncertainty may just prevent capital flows from going to those areas of the world. And obviously, from a perspective of investing, you want to be invested in places where there's capital flowing. That may put a little bit of a damper on that. So obviously, that might put a little bit of a lid on the upside potential for some of these regions of that geopolitical certainty.
And then finally, putting it all together, how do you see 2022 playing out, and what's your outlook for 2023? Because we're almost there.
Sure, and if we sort of look between now and the end of the year, it's a battle of fundamentals versus technicals, and we certainly look at what's being priced in with the marketplace. Might we see a little bit more downside? Sure, we talked about some reasons why earnings estimates might have to come down a little bit more. So that may give us maybe a little bit more weakness in equities. But once we get to that point of fully discounting those sort of downside risks, if you will, and getting comfortable with the terminal rate that we just talked about, I think that's going to give us a pretty good footing in terms of where the market could sort of bottom out. And then again, get back to the technical side. A lot of people bearish, a lot of people basically out of the market. That starts to come back in. And I think that gives us a pretty good impetus for 2023 in terms of total returns.
All right, well, thanks a lot for coming on and talking about it.
Appreciate the invite.